Hey, good morning, everyone. Marty Missouri here, Wednesday, September 25th, 2019, with your pre-market update. Chart in front of you, S&P 500 future chart, the daily charts. We've been following, or we were following, this upward wedge pattern in here, which is more often than not a bearish pattern. We tend to see the breakout come below, which we have here. You know, it was sideways, but it was below the upward trend here, and we're breaking down, further below that, as you noticed yesterday. I have predicted, if you will, I don't like that term, but I have anticipated that we would actually get up here and make a marginal new high before we ultimately roll over into, at least corrective territory. Still not getting there, finding some real, as I keep using the term heaviness up in here. Makes some sense to me. So, we may or may not get there before we see something more dramatic to the downside, if indeed we do get something more dramatic to the downside, which, for a lot of reasons, as I've shared herein, remains my base case. But we'll see. So I did say day before yesterday that we should see a usual test of this line here. I actually kind of have two here. Here's that 61.8 Fibonacci retracement level that was really your August resistance in here, but we did pierce it a couple, 2, 3 times on an intraday basis. So, you can say this white line in here, which would be 29.46, 29.50-ish on the S&P, might be where we get that bounce against that old real strong resistance. It would make a lot of sense to me here to see something like, come down, test this resistance level, get a good bounce back. So get a good bounce off of that. I think any nimble day traders using appropriate stops above and below certain support and resistance levels will trade that area in there. So it makes a great sense to me. Could be there, could be here, could be both. But look for the market, and I think it very well could be today, to trade lower, get a good bounce off of these areas in here, may come on no headlines whatsoever, and then it would just be purely technical. It's interesting how often the headlines do coincide with movements in these areas. So, and then ultimately, I have to tell you, I still expect, more to the downside, and notably so. But of course, that remains to be seen. A lot of headline risk in both directions out there. Of course, I'll have commentary on what develops going forward. Year before yesterday, I showed you the composition of the S&P 500 and suggested that we really should be taking a very close look at technology stocks to get a gauge for how the S&P may trend going forward, because tech makes up nearly a fourth of the S&P 500, and I featured XLK, which is the exchange traded fund or ETF that captures the information technology subindex for the S&P 500, the part that actually occupies that. It's actually 22% of the S&P. So here is the longer term daily chart of XLK. So zeroing in on that, we have we have that August trading range, of course, actually a little higher than that, about right in there. And then, so we have that range that we lived in for a month. We have a defined upward trend here. But here you see yesterday actually coming through. So while the S&P and S&P futures stopped above that August resistance level, you can see that XLK actually kind of barreled right through it. So it really didn't offer any support, at least not yet, for technology stocks, and it stopped just above this trend line. So tech will be a very important thing to keep a watch on today. It'll be interesting to see if we don't get a pop. And that actually could coincide with that resistance level that I just showed you on the S&P 500. So keep in mind, lots of different sectors kind of working together on support and resistance, so it pays to look at more than just one thing on a short-term basis if you're interested. And of course, these things are fractal, so the same kinds of support and resistance and interrelationships exist on the longer-term charts. And of course, from a long-term strategic perspective, for us as investment managers, we use draw many of the same trend lines and patterns and look at momentum indicators on a longer term basis to get a feel for the longer term character of the market. Right now, this is just short term stuff, but I think that's important to help you get your head around what you hear on a on a daily basis and how the market gyrates. So again, barreled through that yesterday, but what does it look like if we really zero in on the 1 minute chart? So here's that line. And as you can see, indeed, traders traded that. So here was that August, which was resistance, became support, bounced off of that, came down, tried to support. That's that 1 minute candle in there, finally broke through it, and then it became that same old resistance that it used to be. And it would make sense to me, although here's where XLK is looking to open this morning. If we get a boost today, it'll be interesting to see that bounce right up against there. So now we have that trend line, which is somewhere down here. And, so swing traders, people trading, highs and lows on an intraday basis, would sell in here with a buy stop above the line. They'd be buying somewhere down in here with a stop loss somewhere below that. So tech is suggesting that we may very well see the S&P come down and testing that August support level even today. Okay, so enough of the intraday stuff that really shouldn't matter a whole lot to us long-term investors, although it does help me zero in on key levels that I am looking for some technical breakdowns that could have longer-term implications and begin more of a move to the downside, which is what I still expect. Of course, there's no guarantees, as I said the other day. Real good, positive, definitive trade news could blow this thing out to the upside in a pretty big way, at least for a short period of time. Okay, so beyond a short period of time, I've been maintaining that if the consumer rolls over, we've got issues. And the industrial sector, the business sector, if you will, has been rolling over. I've been showing you that in the data, a lot of the things we track in our index. And but the consumer has remained strong. And that's not atypical, by the way, of late cycle developments where the business complex begins to roll over. Businesses, last thing they want to do is begin laying people off. They don't want to make those big long-term moves if indeed this is just a rough patch for the economy. But let me show you a couple of statistics that are a bit concerning. So job openings in the U.S. for months and months, when the JOLTS report, job opening and labor turnover report, would come out, I would show you that there were more job openings in this country than there were people looking for work, which kind of defeated the whole notion that we're losing tons of jobs to technology or to foreigners and so forth. Well, alas, the last month, you can see we had negative growth in job openings. And you can see the last time we had that was during this 16% or so 2015, 2016 correction. And then prior to that, it was, of course, right before the Great Recession. Small businesses employed 2/3 of American workers. This was the decline in the outlook for hiring in the last National Federation of Independent Businesses survey. The jobs component, as you can see, dropped notably relative to where it's been. Now, we've been below the zero line a few times during the current expansion, not to the extent that we are right now. And again, it's just another signal that things aren't as good, or at least that companies are beginning to anticipate that if things continue to evolve as they have been, they're going to have to make those cuts that really are going to begin weighing on consumer sentiment. And I did show yesterday, I don't have it loaded up here, but I did show on the blog yesterday that 2 of our 3 consumer sentiment indicators are threatening to roll over. So indeed, it looks like, folks, unfortunately, we are beginning to see some weakening in the knees of the consumer. That's the kind of thing we've been looking for, and that's the kind of thing that ultimately confirms that we should continue to be quite guarded in here with our management of client portfolios. And then lastly, I want to take a look again, and I showed you this the other day, at the earnings per share graph of the S&P 500. So clearly, as you can see over the last 20 years or so, when earnings per share on the S&P aggregated begins to flatten out or roll over, not so good things tend to happen. Minus 21% back there in 98, minus 50% peak to trough when the tech bubble burst, minus 57% peak to trough when the real estate and mortgage-backed security bubble burst. 21% correction, 16% correction. We have had just a real asymmetric exponential rise in earnings per share the last few years. Now that you could view as good. This, of course, you should view as very concerning when you compare it to past periods. The thing that frankly concerns me the most is something I shared with you back on September 12th, and that is the data around share buybacks. I quoted Ray Dalio from his book Big Debt Crises, which is a great read if you're interested. When prices have been driven by a lot of leveraged buying and the market gets fully long and overpriced, that, of course, that's open for debate, it becomes ripe for a reversal. I made the comment that leveraged share buybacks, companies borrowing to buy back their own shares, are the first sentence above by definition. Right? And then here's the troubling statistic. Between 2008 and 2018, U.S. companies spent over $5 trillion buying back their own stock. More than 40% of earnings per share growth has been from share repurchases. So 40% of what explains all of this earnings per share growth right here has been share buybacks. Now, if that isn't enough to have you concerned, get this. Share repurchases have exceeded free cash flow. So free cash flow is ultimately what's left at the end of the day for a company to spend, to invest in new capital, to expand its businesses. Share repurchases have exceeded free cash flow. Now, I'm not going to show you my corporate debt chart that I've shown you a couple of times, but it is concerning as well. Keep that in mind. The fact that repurchases have exceeded free cash flow means that companies have been borrowing aggressively to buy back their own shares, which has increased the risk for both bondholders and shareholders. Even investment grade companies have been willing to sacrifice their credit ratings in order to reduce their number of shares. For example, McDonald's, whose executives depend on earnings per share metrics for 80% of their pay, has borrowed so heavily to fund buybacks that their credit rating fell from A to triple B between 2016 and 2018. Folks, that is scary. And again, think about this in the context of share buybacks. Just to do the math, for example, a company with 1 billion shares outstanding at the end of the year has 1 billion of net earnings. Obviously, they are earning $1 per share, and quarterly earnings, that's what everybody focuses on. What's the per share earnings? And when it goes up, the stock tends to go up. Wall Street rewards that. So if the executives of that company, at the extreme, let's say, buy back 500 million shares, now there are 500 million shares outstanding. They have the same $1 billion of earnings, but suddenly their earnings just doubled on a per share basis. And Wall Street loves it, and the stock goes wild to the upside. Remember, this statistic here is per share earnings. Share buybacks reduce the number of shares outstanding on the same level of earnings. That obviously increases, again, the per share earnings. It's what's called financial engineering. It's a lot, if not virtually all of what explains this move here. And you can see that whatever the reason is for this move, if that begins to wane or earnings begin to decline, again, in a nutshell, you can see why we are troubled while the market basically is at all-time highs. So I just want to make sure that for you clients out there, that we make very clear why, for the first time in 11 years, we are very cautious on our approach to the markets. I'm just kind of giving you a little bit of what we're seeing under the surface, and it's not all bad. And I've expressed that there is some good stuff, and I'll continue to express that when I see that. But we don't like the trends, and as long as conditions are as we see them today, we're going to continue to be guarded in our commentary and cautious as we approach, investment management and allocation going forward. Thank you, as always, for watching and listening, and talk to you again very soon. Bye-bye.